Part 1. Understanding Boost and its business model. Boost is a useful example of how a digital payment business can evolve into a broader financial ecosystem. Many people still think of Boost mainly as an e-wallet. That description is now too narrow. Today, Boost operates across consumer payments, merchant services, financing, digital banking, rewards, cross-border transactions, and enterprise payment solutions. The central idea behind the Boost business model canvas is that everyday transactions can become the starting point for deeper financial relationships. Consider a simple customer journey. A user may first download Boost to make QR payments. Later, that same user may pay bills, use PayFlex for an eligible purchase, access banking services through Boost Bank, or make payments while traveling. One customer relationship can therefore support several different financial products. The same logic applies to merchants. A small business may initially use Boost to accept Do It Now QR payments. Over time, that merchant may also use transaction monitoring, settlement services, payment links, business analytics, or financing. This creates four important commercial engines. The first is the consumer ecosystem, covering payments, bills, reloads, rewards, and flexible payment options. The second is BoostBiz, which supports merchants with digital payment acceptance and business tools. The third is financing, including PayFlex and business-related products. The fourth is Boost Bank, which extends Boost into savings, deposits, cards, transfers, and lending. From a business model canvas perspective, this is important because Boost is no longer dependent on one revenue source or one customer relationship. However, greater breadth also means greater complexity. Payments require reliable systems. Lending introduces credit risk. Banking increases regulatory obligations. Merchant services require support and integration. The strategic question is therefore not simply, how many products does Boost offer? A better question is, how effectively can Boost connect these products into one profitable and trusted ecosystem? That question leads directly into the first major business model canvas components: who Boost serves, what value it creates, and how that value reaches customers. Part 2. Customer segments, value propositions, and channels. The first three blocks explain the market side of Boost's business model. Who the customers are, what problems Boost solves, and how the company reaches them. Boost serves several customer segments. The first group is everyday consumers who use the platform for payments, bills, reloads, rewards, and transfers. A second group consists of digital banking customers who use savings, transfers, cards, or lending through Boost Bank. Another important segment is PayFlex and credit users. These customers value flexibility, but they also introduce credit and affordability risk. On the business side, Boost serves micro-businesses and SMEs that need QR payments, settlement services, transaction monitoring, business tools, and financing. Larger enterprises may require payment gateways, APIs, integrations, or other financial infrastructure. This broad segmentation creates an important advantage. Boost can potentially move customers from one product into another without acquiring them again from scratch. Now consider the value proposition. For consumers, Boost offers convenience, payment flexibility, rewards, banking access, and wider payment acceptance. For merchants, the value is more operational. BoostBiz can help them accept payments, monitor sales, manage transactions, access financing, and improve business visibility. The key strategic point is that Boost's advantage does not come from QR payments alone. Competitors can offer similar payment functionality. The stronger proposition is integration. A customer may use one ecosystem for payments, financing, banking, and rewards. A merchant may move from QR acceptance to business financing or enterprise solutions. Channels then determine how these services are delivered. Boost uses the Boost consumer app, the Boost Bank app, BoostBiz. Do It Now QR cards, payment gateways, merchant locations, APIs, and partner platforms. Each channel has different economics. Owned applications provide stronger control over the customer experience. Shared networks such as Do It Now QR provide broad acceptance, but are also available to competitors. Partner channels can accelerate growth but reduce direct control. For example, if Boost can reach an SME through an existing payment relationship and later offer financing through the same ecosystem, acquisition costs may fall significantly. The challenge is to make these channels feel connected. Customers should not experience Boost Wallet, Boost Bank, PayFlex, and BoostBiz as unrelated products. With the market side understood, the next step is to examine how Boost builds relationships and converts those relationships into revenue. Part 3. Customer relationships and revenue streams. A fintech platform can attract millions of registrations and still struggle to build a strong business. The important issue is what customers do after joining. Boost uses several types of customer relationships. Rewards, cashback, vouchers, Boost stars, and promotional campaigns help attract new users and stimulate transactions. These mechanisms are useful, but they can create weak loyalty if customers move between apps according to whichever platform offers the highest promotion. Stronger relationships are created through recurring financial behavior. A user who pays bills regularly, maintains savings, uses a debit card, or repays financing has a deeper relationship than someone who only uses the app during cashback campaigns. The same principle applies to merchants. A merchant that depends on Boost for settlement, transaction reporting, payment links, or financing is more difficult to lose than one using Boost only as another QR option. Customer support therefore becomes strategically important. When financial transactions fail, users are not simply complaining about a digital feature. Their money may be unavailable. A payment may be disputed, or a merchant may be waiting for settlement. Trust becomes part of the product. Now consider revenue streams. Boost can generate income from merchant and payment fees, payment processing, consumer financing, merchant financing, digital banking activities, payment gateways, and enterprise services. This diversification is important because basic payment transactions may generate relatively low margins. Financing can generate higher returns, but it also creates higher risk. For example, RM1 of payment revenue and RM1 of financing revenue should not be treated as economically identical. Financing income must be evaluated after funding costs, expected losses, defaults, collections, and servicing expenses. Banking creates further opportunities through lending and other financial activities. But it also brings capital, liquidity, governance, and regulatory requirements. Enterprise services provide another potential source of recurring income. Payment gateways, APIs, software integrations, and embedded finance can reduce dependence on consumer promotions. This leads to an important management lesson. Revenue quality matters more than revenue volume. Boost should ask whether revenue is recurring, profitable after risk, and generated from customers likely to remain active. The next part moves behind the customer interface to examine the resources, activities, and partnerships required to make this ecosystem work. Part 4, Key Resources, Activities, Partnerships, and Cost Structure. Digital finance may look simple from the customer's perspective, but operating it requires a significant underlying infrastructure. Boost's key resources begin with technology. The company requires mobile applications, payment systems, banking platforms, APIs, cloud infrastructure, analytics, fraud detection, cybersecurity controls, and credit decision systems. Licenses and regulatory capabilities are equally important. A fintech company can develop an attractive application relatively quickly, but operating regulated payment, lending, and banking services requires approvals, governance, audit capability, risk management, and compliance processes. Another major resource is the customer and merchant network. However, scale should not be measured only through registered accounts. Active users, transacting users, profitable merchants, depositors, and responsible borrowers are more meaningful. Data is also a strategic resource. Transaction behavior can improve fraud detection, underwriting, personalization, and merchant insights. That value depends on strong data governance, privacy controls, and responsible use. Boost also benefits from relationships with Axiata and RHB. Axiata provides telecommunications reach, digital capabilities, corporate resources, and regional connections. RHB contributes banking expertise and institutional experience to Boost Bank. These resources support Boost's key activities. Those activities include processing payments, managing settlements, developing products, assessing credit, operating banking services, onboarding merchants, preventing fraud, maintaining cybersecurity, and complying with regulatory requirements. Each activity affects another. For instance, rapid credit approval can improve customer experience, but weak underwriting may increase future losses. More merchant acquisition increases acceptance, but also increases onboarding, support, settlement, and monitoring costs. That brings us to the cost structure. Boost faces technology costs, customer acquisition costs, merchant support costs, funding expenses, credit losses, compliance expenditure, and personnel costs. The central commercial issue is unit economics. A promotion may increase transaction volume, but if customers disappear when the campaign ends, the acquisition cost may never be recovered. Similarly, rapid lending growth may appear attractive until defaults and collection expenses are included. The best model is not the one with the highest activity. It is the one where customer lifetime value consistently exceeds the cost and risk of serving that customer. With the 9 blocks now understood, The final part brings the model together, through the value proposition canvas, competitive positioning, and strategic lessons. Part 5, Value Proposition Fit, Competition, and Strategic Direction. The value proposition canvas helps us examine whether Boost's products actually solve meaningful customer problems. On the customer side, users have several jobs to accomplish. Consumers need to make payments, settle bills, manage money, access financing when appropriate, and save time. Merchants need to receive payments, monitor transactions, manage cash flow, and obtain financing for business needs. Customers also experience pains. These include fragmented applications, fraud concerns, unclear fees, limited access to credit, payment failures, cash flow pressure, and slow support. The gains they want are straightforward, convenience, reliable transactions, financial flexibility, transparent information, rewards, broad acceptance, and better control. Boost's value map responds through services such as BoostWallet, PayFlex, BoostBank, BoostBiz, QR payments, merchant financing, rewards, and cross-border payments. The fit is strongest when these services work together simply and transparently. Now compare Boost with 3 competitors. Touch 'n Go eWallet has a structural advantage in domestic utility. Its position in transportation, toll-related services, payments, and everyday transactions creates strong habitual usage. GrabPay benefits from the Grab ecosystem. Customers naturally return for rides, food delivery, and other services, which means payments are embedded into existing behavior. ShopeePay gains strength from e-commerce. It operates close to the purchase decision and can connect payments, promotions, sellers, and installments directly to online shopping. Boost's distinctive position is different. Its strength lies in combining payments, consumer financing, merchant solutions, SME financing, digital banking, and enterprise services. That breadth creates opportunity, but also raises the execution requirement. Several strategic priorities follow. Boost should integrate BoostWallet and BoostBank more deeply. Develop BoostBiz into a broader semi-operating platform. Manage credit growth using risk-adjusted profitability. Reduce dependence on broad promotional subsidies. And make security and service recovery part of its competitive proposition. Regional expansion should also focus on reusable capabilities such as credit engines, merchant financing, payment infrastructure, and embedded finance rather than automatically launching another consumer wallet in every market. The broader lesson is useful for any business. A successful ecosystem is not created by adding products. It is created when products reinforce one another, solve connected customer problems, share resources efficiently, and generate sustainable economics. That is what makes Boost an interesting business model canvas case. The company is attempting to transform everyday payments into a much deeper financial relationship.